welcome back. I hope you enjoyed that networking break. Coming up, we're doing Robos in 2020. Robo-Advisors referring to, obviously. And when we talk about that, we've got three experts. Neville Jonas is the president of CI Direct Investing. Neville oversees investment strategy, asset allocation, ETF selection, and investment operations at CI Direct Investing, a Vancouver-based digital portfolio manager. His position actually is enabled him to follow his passions around the digitizing wealth management. He's spurred a lot of innovation in the financial industry and bringing a lot of transparency to clients across Canada. Andrew Kirkland is there as well, co-founder, president, Justwealth. Andrew is an experienced investment professional who has an unwavering passion for investing, financial planning, and making things right for his clients. He's a recognized leader within the financial services industry and was named a finalist for the WP Young Gun of the Year Award in 2018. Doesn't mean he's taking up sharpshooting. It just means that he's in the financial space. He was also nominated for Entrepreneur Innovation Leader of the Year in 2019 for the Canadian FinTech and AI Awards. And Ben Reeves joins us from New York, Chief Investment Officer of Wealthsimple. And prior to Wealthsimple, Ben was an analyst at Bridgewater Associates, focused on asset allocation research, which is what the Robos do, and oversee portfolio construction. Gentlemen, welcome to the panel.
Thanks for having us.
Thank you, Pat.
Thanks, Pat.
Okay, let's start off with the obvious question. 2020 has proven to be a challenging year with the ups and downs. Somebody want to start with an answer to how the Robos done through all the market fluctuations, if you will?
Yeah, I guess I can take the first stab at it, and I can speak from Justwealth's perspective. It was obviously an interesting time. I think there was kind of two avenues or two impacts on the business. So in Justwealth's case, and a lot of other robo-advisors, from our expectations and how we deliver our advice and our communication, and our overall servicing to our investors, was set up pretty nicely for a virtual type of experience that COVID brought upon us. So in our case, the training and all the experience that we had with our clients didn't really impact them there. What impacted them more, obviously, was the markets and the uncertainty of the markets in kind of the last 2 weeks of March, mid to late March. So what we found that it wasn't necessarily the servicing aspect and our communication strategies. It was more on this was the first big shock that us as a company and a lot of our robo-advisors had went through since launching in 2015, right? So how did we manage that? And some of the strategies that we took were, just to do more communication. We were way more active in our communication to our end clients, and we use different mediums to do that. There was obviously written communication, there was videos, there was a lot, obviously, video calls, all that was going on. But throughout that whole process, we were actually, we were in a position where our assets actually went up during the time when the markets were going down. So there was existing investors putting in more money and taking an opportunity when the markets were down, and then there was also people looking to make movements around that time. I believe when there's changes going on, and that was a big change overall in just how people live their lives for, well, now it's been going on 10 months, but that seemed to trigger the way people reacted and what they did with their money and who they had managing their money. So overall, it was from an operational servicing perspective, like our business, at least Justwealth's business, was set up appropriate during COVID. There wasn't much transition that we needed to do at head office, but it was just more how calming the nerves of investors during that time.
Literally hand-holding then.
Yeah, like there was, it was interesting. We thought that if something like that happened, and this was kind of the perception of robo-advisors, how are they going to handle this, like a first, kind of scare on the markets? And I think we were shocked in the sense that a lot of people stuck to what they had said they were going to do during a time like that. And for the few people that did get a little antsy, we were able to talk to them either virtually or over the phone or email, and just tie them back to what they told us when they originally opened their investment account of what is your objective for this investment account, saying, if the markets react like this, what are you going to do with your money? And I think, having that as a pillar as to every single client that comes and opens up an account, you have to complete the investment questionnaire, and that's, kind of the objective, and you're getting that out in the open. I think it was tying that back to investors, and investors, there wasn't much reaction. In fact, more reaction with more people putting in money than, necessarily getting out of the market.
Ben, did you have a similar experience?
Yeah, it's funny. I thought Andrew basically lived the life I was living in March, where we were concerned about how our clients would do with this, and I was really proud and impressed with how our clients weathered the storm. Like really tremendous behavior. And then we have a team of advisors available for people who need to talk through any particular issues. We got a lot of questions about what's going on. Can you help me understand the macroeconomic environment? What should I be doing? And we tried to answer them in a number of different ways through video. We have a magazine that's written by lay people, so we have it in extremely simple language. Here's what's happening in the economy. Here, here's how you should understand what's happening. Here's what central banks are probably going to do, and that seemed to help calm people's nerves. And the thing that really surprised us was, and maybe it's just the uniqueness of COVID, we had a flood of first-time investors where maybe you haven't thought about your finances much. You're sitting at home. You can invest through a computer. So we did get a lot of initial clients and a lot of interest in investing for the first time. We didn't anticipate that, but it was, I think COVID was almost perfectly positioned for that. You combine us being digital, and then also people sort of expect the Fed to bail people out. And also the stock markets are going up for a long time. There's a buy the dip mentality among a lot of investors. And that happened to work out very well this time.
Neville, it's interesting. Both Andrew and Ben have indicated that communication was critical to handling their clients and use different communication techniques. How did you guys handle it?
Yeah, we followed pretty much the similar strategy. We had various channels which we provided education, reassurance, and then we have a team of actual financial planners and advisors, and they took a lot more of the inbound, and they had to deal with issues outside of the just the investment performance and what was happening in the market in terms of people's actual finances. Before SERB was announced, how they dealt with layoffs, how they dealt with future plans that they may have had. So there was definitely a focus, especially on our planning team, to ensure that people were still getting that planning advice to deal with a level of uncertainty that they hadn't seen. And that was all done on an individual basis, in addition to all the direct media channels we were pushing our information out through.
Okay, you brought up an interesting word, performance. That's part and parcel of 2020. I mean, lots of volatility, market moved down a lot. And I know that each of you have lots of portfolios, different portfolios that are designed for different means. But on the whole, if you had to characterize how your performance was or has been through 2020, how would you characterize it? Neville, I'll start with you.
I'd say our performance has stood up for 2020. During the crash, we got hit hard because every asset class declined, including fixed income, by significant amounts. And when we were using ETFs to cover fixed income, there was even bigger gap because of the, let's say, liquidity issue. But, coming out of that, when the market started to return back to normal, all our performance of all our portfolios are back within ranges where we expect them to be.
Okay, so if the TSX is up 3% so far this year, ballpark it, would most of your portfolios fit into that, or would you have done better?
Our balance would probably be around that, and our aggressive would be better.
Wow, good. Andrew, same kind of experience?
Yeah, and this is the beauty of doing an interview or a panel on Zoom. You can actually pull this data up right away. So I'm just looking online here at our November 30th numbers. Our global balanced growth portfolio, the 1 year number is around almost 8%, 7.7%. And honestly, that's kind of the norm for across all the risk levels. We kind of have a risk rating scale of 1 being low risk, 5 being high risk, and kind of an asset allocation amongst all those 5 risk levels. And it's in around kind of the 7 to 8% on a 1 year basis. Now, that's our growth portfolios. So we have kind of an objective for obviously capital appreciation. We also have income portfolios, which combine is more of a total return approach using income sources. And I will say with those particular asset classes that are in those portfolios, the 1 year over year return is not as high as it is on the growth lineup. So, and I think that's just what we've seen over the course of the last 12 months. More growth oriented equities have performed better than some of the income type of investments. I think more recently we're starting to see that kind of turn a little bit, and more of the income approaches are coming back into favor. But I think for the lion's share of people who are investing at least in our lineup, it's in our growth portfolios, and those seem to be doing kind of the 7 to 8% rate of returns.
Ben, in your case, your AUM, you've got a head start on almost everybody in the robo space. Your AUM's got to be larger, I would suspect. I don't actually know. But it's also more difficult to run that kind of money through this. How have you done?
So we tend to be positioned a little more defensively than sort of many of our peers. We strategically hold long duration treasuries and hold minimum volatility equities. So that really helped us weather March very well. I think we're down about, in our 50-50 strategy, down about 5%. Our strategies for retirees were down about 2.5%. And then kind of across the board, they're up maybe 9%, 8% this year. Our strategy in helping our investors manage their behavior is we want to do a little bit better when it's really scary, and then give up a little bit when it's when the stock market's doing very well. So this was sort of a very good macroeconomic year for us to have for relative performance.
Okay, against those backgrounds then, and performance part of that, how have you gentlemen all been marketing? And I don't know whether that's fair for you, Ben, to be honest, because you're not in the marketing space per se, but maybe you could give us your insights on how you saw the firm evolving its marketing, whether that's to individual investors or to advisor or whomever.
Yeah, and I think portfolio review service, which enables clients or investors or potential investors to upload a copy of their statement. And then we do a very in-depth review of that statement by a live portfolio manager. So, we look into the overall diversification of where their account is right now, the account structuring, and then obviously kind of a cost breakdown for them. But we found that when COVID hit, people were looking at more of their finances, whether their own personal finances they had with Justwealth and maybe putting in more money, or at other institutions, they wanted to get a kind of a second opinion. So from a marketing perspective, what worked well for us is kind of making that service more aware to the general public, and it seems to be that people like that service, and it's something that we found the success rate of doing a portfolio review on an investment account. The conversion that we saw after we did something like that was particularly high, and the outcome was probably some type of amalgamation of their assets to Justwealth if they liked what they heard. But we found that it was a larger asset clients that were taking us up on that service, and it was just more making that service available and more known to the public via any marketing levels we have, whether it was social media, whether it was through any partnerships we have with our advisors. It was just making some of our services more visible to the end user.
Neville, what are your thoughts?
We just continued our existing marketing strategy where we focused on digital marketing directly to the type of client we wanted to attract. We did increase our communications to our advisor group, and we spent more time working with them because we felt that they had the biggest challenge ahead of them in terms of dealing with clients. So typically they would deal with clients in person and then introduce us to help manage the investments. And we found that providing them with additional support was beneficial for their businesses.
I'm curious though, because I would think you had a bit more of a marketing challenge in that, or is it a challenge? I don't know. You had kind of a name change. You went from Wealth Bar to CI Direct Investing. That can work against you, but obviously because of CI, it can work for you. How did that play out?
It was a mixed reaction. We definitely had clients that were affiliated with the Wealth Bar name and brand, and they felt that there was that change or something unique. But then we had a bigger group of clients that were supportive of a large financial institution providing support to our growth and providing them with additional services. So it was a mixed bag, but overall, it's been positive for our clients. And in terms of the name change, we dealt with that in the summer, and it wasn't at the same time when everything else was falling apart in terms of clients' investments and like the world around them. It was just something that happened, and it was not something that they weren't prepared for, because CI took an initial investment in our business at the beginning of 2019, and we announced that partnership and that investment at that time. So this was just a natural transition.
Ben, again, not fair to you, but do you have comments on how marketing went at Wealthsimple?
Yeah, I do. I'm more learning than doing the marketing, but I do. I think that the different thing that the little different tack that Wealthsimple takes is we want to be, we think about the whole person and just have a brand that's not necessarily talking about finance all the time. So we have a magazine where a guy who used to edit GQ is writing interesting things that are tangentially related to money. We just want people to be comfortable thinking and talking about money with us. And then we want to have very sort of delightful experiences with our technology. We think if people use our technology, they're going to share it with their friends. And then if we can generate things that they like and they're interested in and also share, that's some pretty effective marketing. So in addition to the portfolio review type thing, it's really let's have a brand, let's have an experience that people really like, and not necessarily just about investing.
Ben makes an interesting point there. I was going to say about kind of if the clients or the current client likes the overall experience, they'll potentially talk to somebody else that they know. And we, and I don't know about the other two companies, but we have a referral program where if the client sends somebody, each person gets a free month. But we often find that we make that available, but people just don't even actually, do the essential process to kind of trigger that 1 month free. They literally just say, if I'm happy with Justwealth, I want to tell my friends and family about it. And then we start to see additional, clients come on board. So it's no different than any, I think, financial advisor, any investment portfolio manager. I think a big source of a way you get new clients is because you do a good job for a current client, and then a new client, they'll tell a new client, whether a friend or family. But I do feel that was a little bit of an uptick in that sense on the referral nature during that time, and it had been just because the discussion of finances was coming up more during that time, right? Whether it was how do I access government funds for whatever reason, or even how do I have my investments managed. So it just seemed that it was potentially more of a conversation amongst friends and families, maybe a little bit more than what typically is the case.
You bring up an excellent point, though, because at its early iteration, Robo-Advisor was direct to consumer. It was a retail product that was out there. But Neville, you brought out the whole concept of working with advisors. How do you do that? How do you communicate to advisors, and give me your elevator pitch. I'll ask you all to do the same thing, but give me your elevator pitch on how you approach advisors.
So our target group of advisors that we've been approaching are those that want to continue financial planning but don't have the investment expertise. And that's where we're providing a low-cost digital solution for them to present to their clients to give them that level of investment options available.
But in the early iteration, you would have been a threat to them. How do you get over that hurdle?
I think it's just the adoption and the type of advisor. So the advisors that we're working with, they're more focused on the financial planning, and they realize that, them providing investment advice is not something that they have the, say, appropriate resources to do or would want to do versus focusing on that planning relationship.
Ben, I think you guys, well, you had an advisor business. I believe it's not part of your umbrella now, correct?
Yeah, that's correct.
Okay.
We do, though, we see many advisors as being extremely aligned with our mission. Like, we want to provide financial freedom. We want to provide really high quality, low fee products and get people to great outcomes. We think advisors are doing exactly the same thing. Once we got out of the advisor business, we were starting to think about how we can work with them. We've launched a couple of ETFs that we're excited about that we hope advisors will use. We think they are high quality, low fee, a little bit more sophisticated risk management than we can do in our core strategies. And then we're also launching a Sharia compliant ETF in January, because that seems like there are a number of advisors in that space, but the investment options aren't great. So we're looking for areas where we think we can add value for advisors. And right now we see it more on the, let's give you a nice low fee tool to implement some exposures with your clients. And you can use our scale to sort of help make that happen.
Ben, I'm going to come back to your ETFs because I think that's fascinating. But in the meantime, Andrew, how are you approaching advisors?
Yeah, so we've kind of broken our business down into three channels, or three distribution channels, if you will. We've got the direct to consumer, we've got our advisor channel, and then we have a group channel, which we can work with groups through advisors. And in fact, there's a lot of group benefits advisors that are utilizing that platform. But the fastest growing segment of our distribution channels this year is the advisor channel, and I think it's to the point where advisors, there's a lot of things that are tasks that they're doing that they don't want to necessarily do anymore, whether it's the annual KYC obligations, the administration, the trading, that a robo-advisor can assist the advisor on. So I think what we're seeing, advisors are transitioning their overall business and setting it up as an outsourcing model, and we are just one aspect of that outsourcing. They're outsourcing their investments to us. Now, I think a lot of advisors, when we talk about this, there's obviously what you mentioned, Pat, about the risk early on in the early days of robo-advisors to a traditional financial advisor. But I don't. From our perspective, that was never the case. We have a direct-to-consumer model, but that was what we originally launched with. But we launched with that all knowing very well that we were going to be getting into the advisor business. I come with a background in distribution, so I just knew there's always something to be said about a financial advisor and the value that they're providing their clients. And if we could just provide the technology and the efficiencies that a robo-advisor can deliver in that value add type of scenario that an advisor and the end user has, I think it makes a lot of sense for the advisor. And when you look at the costing, it can be sometimes significantly lower cost relative to what the investor now is getting if they're invested in, say, for example, a mutual fund or something like that. So it's a growing model. I think it's going to grow rapidly in the next few years as more advisors see the fact that a robo-advisor isn't necessarily a threat, and it could be a very powerful partner in their overall business that they're trying to deliver to their clients.
Ben, I want to go back to you and this whole concept of introducing your own line of ETFs, because a robo is de facto an asset allocation tool and a process. How are you designing your ETFs with that in mind?
So for the time being, we're only designing ETFs where we want to put something into our portfolio and we don't see the exposure available in the marketplace. So we'll go make it. It started out with socially responsible investing, where we had a portfolio that was very popular, But then when we looked at the underlying ETFs, it didn't really match with the value proposition we were offering, which is people don't want to invest in things that they don't agree with. They don't want to profit from companies they find socially disagreeable. We did a search, didn't find anything that was restrictive enough, weren't in love with the ESG score and the sort of optimizing to a market cap portfolio method that's pretty common. So we ended up making our own, but it's more, we don't see the thing that we want, let's make it. And now we have the scale now to do it in a way where we can offer it at a reasonable fee. And it's the same story with Sharia compliant investing. We look in the market, there's not a lot out there, small products. This is something that we can offer to these clients, and also just offer to people outside of Wealthsimple that we think helps them achieve their goals and is a high quality product.
Neville, with your access to CI direct investing, do you see yourself going into the ETF space?
I see it's creating lots of interesting product, and as those ETFs are launched, we will evaluate them and see how they fit into the portfolio. Right now, our mandate is fairly open, and as long as we find ETFs that meet the asset classes we want to represent in the portfolio, we will use them.
Okay, so if you were to pull out your crystal ball, and Andrew, you kind of touched on it a little bit, but where do you see the growth in your business in the next year or so? Will it be people taking more financial responsibility and coming to you directly, or will it be through advisors, as you suggested, Andrew? Or I'll start with you, Andrew, and go from there. 2021 is what I want.
Yeah, so it's going to be interesting. I can only imagine that the advisor adoption and for robo-advisors will continue. It's something that we've personally seen in our business over the last almost 12 months, and it's been quite significant. So I would expect that will continue to grow. It will also, another thing that we're also noticing is, if you see some of the reports and the statistics coming out, that it seems as though Canadian investors, there's been a significant uptick in the do-it-yourself investor from a lot of discount brokers. And any numbers that I'm looking at from investor economics, there seems like there's been a significant uptick there. So it'll be interesting to see how that adoption, or I guess that driver, impacts the robo-advisor industry. Maybe people thought they could do it themselves because they just wanted to not deal with an actual person or someone at their bank, but then they get into that avenue and they realize that it's more complicated and it takes more time than what they had actually perceived it would. So maybe they kind of resort back to maybe a robo-advisor. So I think the advisor adoption and then that continued growth would be one thing that's a key driver for this business. But then there's also this kind of wave, if you will, on the do-it-yourself investors, and are they going to stick in the do-it-yourself or transition to something like a robo-advisor?
That plays right into your hand, I would think, Neville, wouldn't it?
Sorry?
That plays right into what you do. Your name says direct investing.
Yes.
Never mind, you've got increased distribution through CI.
Yeah, so we're going to continue to focus on our direct-to-client business. We are integrating trade into the CI direct investing platform by taking virtual brokers, which is currently part of the CI family, as a direct investing self-direct platform, and that will be integrated into CI direct investing. So there's definitely going to be a source of growth for next year.
Okay, good. And Ben, for your part, where do you see your growth? And I'll recognize that you've gone beyond just the straight, robo advice. You have a bank now. You've got all kinds of other.
And our goal is to be the primary financial relationship for the future majority of Canadians. And they are asking us to make more products because we've designed technology well that's really easy to use and simple, low fee products, and that's something that really resonates. So we have discount brokerage, we offer tax preparation, we have a spend and save account, and so you'll see us continue to roll out new products and try to grow them. And then in terms of our invest business, we're just looking to expand the ways and the moments where we add value for our clients. So that means improving our technology and improving how easy and delightful it is to work with us.
Okay, so we've got some questions coming in from the audience. This one's from Mark Molzanski, and this one's for Ben, slightly off the topic, but when is your platform, Wealthsimple Trade, going to be able to catch up to other brokers regarding handling RIFs, LIRAs, joint non-registered accounts, and so on?
I don't know.
Fair enough, Mark. Get a hold of somebody.
Mark,
Wealthsimple.
Mark, seriously, if you can get my email, I'll get you an answer, but I don't know the answer.
Okay, that's good. This one's from Victor Medina Lil. What fee for service model do advisors use when outsourced to a robo-advisor, the investment portfolio management services they offer their clients? That's interesting. I'll leave that to Neville or Andrew.
Okay, I can take that. We set up so that the advisor can charge a financial planning fee. They charge that directly to the client, and we administer that. And typically, it's capped at 1%, and it ranges depending on the level of service the advisor is going to provide to the client.
Andrew?
Yeah, so this is similar to CI direct investing. It's capped at 1%, and it's set up like a referral fee. So when an advisor comes and wants to partner with Justwealth, we set up kind of a website for that advisor at a co-branded website, and then the advisor can use that website for any clients that they want to refer to Justwealth. So that's how kind of from an operation standpoint it works. But then from a compensation standpoint, the advisor would have selected what their ongoing referral fee or financial planning fee would be. We have 4 levels. It's 0.25, 0.5, 0.75, and 1. However, if they would like to change that for any of their clients, they pick one fee, and that's their kind of going fee for all of their accounts. But if they'd like to change that and override that, we have a service that allows that on individual clients. But then, yeah, we administer that referral fee, the investment management fee, and then we compensate the advisor based on whatever their fee portion was.
I know that fees are always an issue when it comes to anything involving ETFs. And I think the average fee on an ETF is, 20, 25 basis points, something along those lines, which I presume you pass on to the consumer. But what about your own fees? Over the next year, do you see your own fees declining? Do you think they'll go down because of market demand or AUM or any other reason? Ben, I'll start with you.
I don't see our management fees declining. I think we offer a really high quality service, and it's reasonably priced. We are going to look at the fees we're paying on implementation, and can we do things to reduce those.
Okay, Neville?
Yeah, we're not, like, part of our fee includes financial planners and advisors that we have on staff. So directly, we won't be adjusting our management fee going forward.
And Andrew?
No, I can't see that happening. Again, there's trading, there's administration, there's custody costs, along with the expertise that we're providing, and we think that with that 0.5% on an annual basis, it's that for an overall investment management fee that covers a lot of aspects for an investor. It's a very, very low cost method for what we believe is a high quality product.
Here's a question, probably best landed for Ben, because you've got that kind of international perspective. But I wonder if the Canadian marketplace is big enough for the number of robos that we have. And do people see expansion of the Canadian robo model to the United States? Ben?
I think there's plenty of room in Canada for us all to do better at how we serve Canadians, and I think there's room for competition. So I think the industry is going to continue to evolve. The level of financial assets and wealth is going to continue to grow, and I think there's a lot of room for everyone. I'm not quite sure on the Canadian model for robo-advisors. I think the challenge you have is getting the word out, and that's a tremendous amount of investment for any company. So if you're going United States, you're in a lower fee, much more competitive market. where it costs a lot to get people to know who you are. And I think that's going to be the same for anybody. I think if a Canadian robo-advisor can build a better mousetrap and then potentially marry that with distribution for a company that might be struggling to do a digital first service, maybe there's channel conflict or like internally it's hard to build, like there may be something there. But international expansion so far seems pretty difficult.
Andrew?
Yeah, I would say here in Canada, like we're licensed in all 10 provinces, and the robo-advisor industry as a whole, relative to the full financial asset industry, is still quite small, right? Relative here in Canada. So I think you would expanding outside of Canada right now into a jurisdiction that you may not be familiar with would I think open up too much to take on when there is obviously a growing industry here in Canada where there's a lot of room for growth. So I think to Ben's point, there's probably room for more competitors. We're seeing it all the time. Like, a lot of the banks are coming into this space. There hasn't really been much on the independent side more recently. In fact, with Nibble's company, they partnered with a kind of a large asset manager. I think there's probably things there where other large asset managers in Canada will look to get into the robo-advisor space, and will look to the people in the robo-advisor space and see if there's an opportunity to partner. You may be seeing that. But I think there's still a huge opportunity in Canada to get this message out, and lots of room for asset attraction.
Neville, so two-part question, that U.S. expansion or international expansion, and probably more viable with CI, maybe. And then do you see more consolidation in the industry? But let's start with the expansion part.
Yes, CI has definitely been focused on global expansion, and that's been in the US with the RIA acquisitions. As far as the direct investing channel, our focus still continues to be Canada. Depending on how the global growth goes, especially with these RIA acquisitions, there could be opportunity there. And then, what was the second part of the question?
About whether there be more consolidation in the industry or more expansion in the industry, or how it's going to play out. Andrew's suggesting that other financial management companies will get into the robo business. What are your thoughts?
I feel there's still opportunity for other financial groups to get into the business. Like if you look at the banks, not all of them have digital offerings available. TD just launched one, so you still got one or two other major banks that don't have a digital offering direct for their clients. So there's definitely opportunity for growth there. And as far as consolidation, we saw consolidation this year, not just our company, but Modern Advisor was acquired by Guardian Capital. So I would expect there to be more decisions in terms of, or analysis in terms of buy it versus build it from existing players, determining whether or not they want to service their clients with a digital solution.
And then I'll make this the last question because we're almost out of time. Do you guys ever do predictions? Like, do you do economic forecasts and that kind of stuff? Because I'm wondering what your corporations are saying about what the markets look like or what the economy looks like down the road. I don't know whether you do, but you guys would know better than I. Ben?
Our investment philosophy is collect a risk premium from holding risky assets and be prepared for a wide range of outcomes. And then think about how those different scenarios can work and make sure you have assets that are going to outperform at different periods of time. So that did cause us to shift our asset allocation a little bit this year when a lot of the bond yield curve hit zero. But beyond that, we're saying we have risk allocated to assets we think we're going to do well. If the economy really falters, we have risk allocated assets that we think are going to do well if the economy does well. And we have some assets in there that'll help in an inflationary period. That's more of our asset allocation approach. And let's be pretty geographically diversified. We don't really want to make a call beyond that.
But how do you communicate that neutral positioning, if you will, to your clients? And do they understand it?
Our clients understand the term passive. which means not making a prediction on what's going to happen in the future. I think fewer of them are going to understand, okay, we're going to construct the portfolio in this particular way. And that's going to lead to, this range of outcomes in different conceptual economic scenarios. They are happy though, say like in March, we did well because we were, positioned in a way that helped minimize losses. So they'll be more looking at the pattern of returns, and we're trying to communicate that, hey, we might do a little bit better when the stock market does poorly. And we might do a little bit worse when the stock market does really well. And that's gonna, if you stay the course, you're gonna compound your wealth over time and do the right things. So that's more what the messaging is about.
And Neville, you've got access to some of that economic news and economic updates and investment updates. What's your call, if you will?
I'm not making a call. What we do is we get our clients to focus on what they can control. It's how much money they can deposit into their accounts, how frequently they should make those deposits, which accounts to put that in. And that's how we will encourage our clients to stay focused and invest in 2021.
Good. And Andrew, last word to you.
Yeah, I would just say, like, our message on kind of outlook and economic forecasts are, it's not something that we come out and publicly say. A lot of the times, we deter people from making decisions based on an opinion. Market timing is as good as gambling, and we often say that to people. If anytime you want to potentially time the market, whether it was based on a U.S. election or a COVID vaccine, or it's always something that's not a practice that should be employed, and we try to avoid it with our clients. And I think the other thing is, and I mentioned this earlier about back in March when there was a lot of clients who actually felt that this was a good opportunity to put money to work, which is a good practice, and it's something that they saw, and they were obviously right. But even in that time, us as investors, anyone doesn't really know what's going to happen in the next week, days. We don't know. So we were actually employing people to, if you had money, take a strategic approach to allocating that capital on a more of a dollar cost averaging basis, right? So you try to avoid necessarily making super rash decisions of a turn of volatility, and just be more strategic and be more focused on the long term.
Well, I got to say, gentlemen, I thoroughly enjoyed that. Thanks so much. Ben, Neville, Andrew.
Thank you.
Have a great day. Enjoy the rest of the conference.
Thanks, we shall. Okay, coming up though,